Hello! Welcome to our Tulane University Spring 2016 Birken Road Report. Today's investor presentation is our continuing coverage of Amerisafe Incorporated. I'm Josh Zuckerman, and I represent my fellow analysts Bjorn Bernhardsen, Dennis Correa, Kate McCabe, and John Paul Navarro. Our analyst team gives Amerisafe a rating of market outperform and a 12-month target price of $61. Amerisafe's 5-year stock price performance is shown in this graph. As you can see, Amerisafe has had steady growth over the last 5 years. With a March 15, 2016 closing price of $50.38, we forecast 20% growth over the next year to a new stock price of $61. Our agenda for this presentation will cover a brief overview of Amerisafe, an industry analysis, a discussion of our investment thesis, and finally, our valuation methods. Amerisafe was founded in 1985 as a workers' compensation insurance firm centered on the logging industry. By 1994, it began to cover additional sectors, but it has always focused on employers in hazardous industries. Today, 60% of its insurance coverage is in construction and trucking, but the company also has a presence in sectors such as manufacturing, oil and gas, maritime, and logging. The company is also diversified in its geographic coverage. For example, no more than 13% of its policies are written in any single state. Therefore, Amerisafe has some built-in protection from regional economic troubles as well. The 3 largest states in terms of coverage are Louisiana, Pennsylvania, and Georgia. The company maintains a generally conservative approach to growth. Mergers and acquisitions are rare, and almost all of the growth for the company has been organic. There is a strict vetting process for both prospective clients as well as for companies that want to remain insured by Amerisafe. That's why Amerisafe emphasizes workplace safety audits and a thorough understanding of the risks faced at each job site. Due to the particularities of hazardous industries, employers have generally not been highly coveted by the largest insurance companies in the U.S. This lack of competition among insurers has provided a competitive advantage for Amerisafe. The company has also focused on small to mid-sized firms, which are not as appealing for the largest insurance companies. The companies Amerisafe insures tend to have less frequent but costlier claims on average. This is due to the nature of workplace injuries for employers in hazardous industries. Due to years of experience in these sectors, Amerisafe has experience with these kinds of fluctuations and the financial strength to withstand abnormally high periods of claims. Currently, 48 out of 50 states require employers to carry workers' compensation insurance. The health of this industry is often measured in net premiums written. In 2014, $46.8 billion worth of premiums were written. This was a 13.3% increase from the previous year. Amerisafe operates in the niche market targeting small and medium-sized companies within hazardous industries. This niche market shields Amerisafe from the highly competitive nature of the overall industry. Additionally, hazardous industries are even more highly regulated in regards to workers' compensation insurance than other industries. This locks in Amerisafe's relatively stable and constant stream of clients.
Despite stagnant pricing, Amerisafe has benefited from an uptick in policy writing. With continued economic growth and rising employment, investment income remains positive. The property and casualty industry as a whole has entered a period of increased competition and decreasing premium prices. The property and casualty sector saw an average pricing decrease of 2.9% per quarter in 2015. But despite stagnant pricing, Amerisafe has yet to see adverse effects on revenue. It is impressive that the sudden industry softening has hardly affected Amerisafe. Since the beginning of 2011, the unemployment rate has declined from 9.1% to 4.9% as per the graph shown on the screen. More workers equate to large amounts of policies written and therefore more revenue. As long as the company maintains a high exposure to its targeted labor force, it will continue to enjoy growth. Amerisafe exercises a very conservative and disciplined approach to underwriting policies, even turning away potential customers in order to protect its bottom line. Amerisafe also maintains an attractive combined ratio compared to many of its peers, with a value of 80.53 at the end of third quarter 2015. With its strong policy underwriting knowledge in the hazardous industry field, this ratio has remained competitive as far back as 2007. Amerisafe has remained debt-free after paying off all its debt in 2012. Since then, the company has employed some of its excess capital in quarterly dividends. The most recent end-of-year dividends were distributed on December 10th of 2015 and were at an all-time high of $3.15. This dividend trend shows no sign of changing and in fact signals a strong choice for those looking for a good return on investment. A combination of industry regulations and low interest rates prevent Amerisafe from making significant returns on its excess capital. Despite the Federal Reserve raising interest rates in December 2015, the yield on 10-year U.S. Treasury bonds remains at near historic lows. Low bond yields are particularly problematic for the workers' compensation insurance industry, because regulations require that the majority of excess capital be held in conservative investments such as municipal or highly rated corporate bonds. The return on these investments is closely tied to the benchmark 10-year U.S. Treasury yield. As shown in the graph on screen, over the past 2 years, Amerisafe moved toward a diversified investment portfolio by increasingly buying corporate bonds and reducing the percentage of its portfolio in state and municipal securities. Amerisafe does not expect to significantly improve its return on investments until interest rates go up. We determined our 12-month target price of $61 by using 3 valuation methods: discounted cash flow, price to earnings, and enterprise value to EBITDA. The discounted cash flow model predicts Amerisafe's operational and investing activities, while the price to earnings and enterprise value to EBITDA models incorporate valuable market expectations on industry earnings and company value. For the discounted cash flow model, we use the capital asset pricing model to calculate Amerisafe's cost of equity to be 7.51% and incorporated a 1.5% liquidity risk premium, bringing the discount rate to approximately 9%. A liquidity discount rate was added due to the company's relatively small market capitalization and low trading volume. With this 9% discount rate, we calculated the present value of each cash flow for the next 4 years and then assumed a terminal value growth rate of 3%. With this approach, the discounted cash flow model predicted a 12-month target price of $54 per share. For the price to earnings model, we took the mean of 5 comparable insurance companies, resulting in a PE ratio of 14.82 for the trailing 12 months. This estimated a 12-month target price of $61 per share. Lastly, for the enterprise value to EBITDA model, we used a relative EV to EBITDA ratio of 11.2, which was based on the average of selected peers. With this, we arrived at an estimated 12-month target price of $66 per share. The 3 bars on this graph represent our 3 valuation models, with the red line showing our 12-month target price of $61, while the dotted green line displays Amerisafe's current share price of $50.38. We took an equal weighting of our 3 valuation models to arrive at our 12-month target price of $61 per share. The Birken Road reports are produced solely as part of an educational program of Tulane University A.B. Freeman School of Business. The reports are not investment advice, and investors should not regard the presentation as recommendation to sell or buy any securities mentioned. Investors should consult an investment professional and/or conduct their own primary analysis before making any investment decisions.